Launch.
Hello, everyone, and welcome to our webinar today. I am so excited to have you all here with us today, and we're going to get started in about 3 minutes. The number of participants is climbing, which I think is just as exciting as the panelists that I have here to speak with us today. So sit tight for about 1.5 more minutes. All right, it's go time. Like I said before, welcome everyone, and thank you in advance for spending a couple hours with us. This workshop is called Tapping the Potential of Special Purpose Credit Programs. And I'm really excited about the experts we have here to talk with us today. And I'm also really excited about how many of you decided that this was an important way to spend a couple hours. You know, initially when I was thinking about what we were going to talk about, the overview, I was thinking I was going to spend a lot of time talking about why special purpose credit programs are important. But the sheer number of people who signed up for this webinar made me realize I think that is something that we're all becoming very aware of. And that's really exciting. And so before I get into introducing our panelists and diving into the why, the hows, the nuts and bolts of SPCPs, I just want to cover a couple things on housekeeping issues. We have shut the chat down since there's so many participants, but we would love for you to use the question and answer options. My marketing director, Megan Horn, is going to be moderating that. And we're hoping to have about 10 or 15 minutes at the end of our presentation and discussion to answer your pressing questions. So again, let's talk a little bit of an overview of what we're going to go over. We're going to talk a little bit about the why, an overview of SPCPs, you know, really get into the nuts and bolts of, you know, what do you need to think about? What are the components? All the different pieces you need to consider when you're thinking about creating one, implementing one, evaluating one. But really what we're going to also focus on is getting a lot of good conversation and feedback from these excellent experts that we've pulled together. So I'm going to kind of get started here. So as you know, this is a difficult time in our industry. This has been a really tightening market. And, you know, at least in our work, what we are seeing is a lot of concern and worry from a lot of our lender clients about the way the market is headed. So that certainly is forefront of all of our minds. But at the same time, this is a really unique and a perfect time to be talking about SPCPs and other programs, because it really, this is an intersection of a lot of different things. One of the biggest trends, obviously, that we're seeing is that demographics are changing. The U.S. homebuyer pool is growing, and it's being driven primarily by diverse households. So if you think about the demand line, it's going up. At the same time, the homeownership gap between non-Hispanic whites and diverse households is widening. That's going down. You look at those two lines, and you see this big gap that's coming, that's continuing to grow. And if you look at this slide here, you can see markets all over the country. We see that gap. So the blue line here is the non-Hispanic white homeownership rate, and the red line here is the minority homeownership rate. That gap in between each one of these metropolitan areas is the opportunity that I think we all feel is present with special purpose credit programs and the households, and I really want to say forgotten segments that for years we haven't been able to reach, like we have non-Hispanic white, and not just non-Hispanic white, but middle and upper income borrowers. So it's kind of going back to that other one. It's kind of this intersection of those two trends, the tightening market. And then right now we have an administration that is really committed to not just ending discriminatory behavior, but proactively promoting equity. And it's those four things come together, and that's really why I think the time is now. It's a win-win-win. Lenders and practitioners in housing who understand that and take advantage of this environment, really will originate more loans. They'll obviously face less regulatory risk, and at the same time, they'll build healthier communities. So I see this is a unique time to have a webinar like this and to get started and talk about what we can all do, whether it's with special purpose credit programs or other types of strategies, to start taking advantage of that opportunity. So with that, I realize I never introduced myself. So I'm Laird Nasuli, and I'm the CEO of iEmergent. And iEmergent is a company that is dedicated to helping lenders grow while also closing the homeownership gap. And we have a collection of data, tools, and advisory services that we offer to do that. I'm going to have each of these attendees or presenters introduce themselves. And I'm going to start with Olivia Kelman.
Hi, it's great to be here. Olivia Kelman. I'm a partner with the law firm K&L Gates. At the firm, I serve as the co-chair of the Financial Institutions and Services Litigation Practice Group. My practice focuses on representing participants in all parts of the consumer credit industry and other financial institutions as well, with a particular focus on fair and responsible lending, CRA issues, and a heavy focus over the years in the mortgage industry. So I bring a lot of experience to light, both with the legal requirements that drive fair lending concerns and the requirements of the special purpose credit program under ACOA, but also a deep knowledge of the challenges, the risks, the concerns facing the industry, and can assist with creative solutions to bridge those gaps.
Thank you, Olivia. Mose, would you like to go next?
I'm Mose Gatling, and I'm a sales manager with Loan Depot in Las Vegas. And I guess my lane in this whole situation would be, I've built a team here at Loan Depot that does a lot of lending in the minority area. And it's been proven that some of the steps we've been taking to do that and be the boots on the ground for the company in doing so, we've managed to be able to successfully do that and also help our homeowners sustain their homes as well. So that responsible lending piece and just building a successful team that can meet the buyers where they are out here.
Well, we're certainly excited to have your insight, and I know everyone will enjoy it when they hear it. Okay, Jason, another lender?
Hi, everybody. Jason Fraley. I'm with the Huntington National Bank. We're a $179 billion lender based out of Columbus, Ohio. For our home lending department, I run community lending, credit policy, and product management. Looking forward to speaking with you today.
Thank you, Jason. All right, Mr. Rob Crane.
Thanks, Laird, and great to be here. Hi, everybody. I'm Rob Crane, founder and CEO of Down Payment Resource. At Down Payment Resource, we help our business partners connect home buyers with the down payment help they need. Those business partners are lenders, of course, lenders of all types and all sizes, multiple listing services around the country, large public search portals like Zillow and Redfin, and nonprofits. So we do this because we built a database of all of the down payment assistance programs and really about 12 categories of affordable lending programs. But it's over 2,300 programs. About 74% of those are some type of down payment assistance and closing cost help. And we keep that up to date on a monthly basis. So glad to be here. Looking forward to the session.
Thanks, Rob. Lindsay.
Thanks, Laird. Pleasure to be here. My name is Lindsay Canaday. I am the Vice President of Business Development at Green State Credit Union. Green State is the largest credit union in the state of Iowa. And at Green State, I lead our affordable home loan program. It is a $1 billion initiative to increase home ownership for minority communities. As a part of that program, I focus on our minority community outreach, as well as retention and recruitment of employees of color to make sure that that program is operating successfully. So pleasure to be here.
Thank you, Lindsay. Evan.
Hey, good afternoon, everybody. My name is Evan Zuverink. I run corporate community reinvestment for First Commonwealth Bank. First Commonwealth is headquartered in a little town called Indiana, Pennsylvania, but our current footprint extends from basically Cincinnati, Ohio, all the way east to State College, Pennsylvania, with plans to expand with a new acquisition sometime in early 2023, which will take us into the Metro Philadelphia market. So we are actively in the throes of crafting our first SPCP and currently working with outside counsel. And so we'll spend a little time talking with you guys today about the process we went through, kind of what we're thinking, and kind of where we're at in that process. So thanks.
Thank you, Evan. And certainly last, but certainly not least, Gabe.
Hi, folks. Gabe Del Rio. I'm CEO of Homeownership Council of America. We're a national nonprofit organization whose mission is to bring more equitable access to homeownership credit for America's underserved communities. And we do that primarily through our two main program lines. One is Community Lending Initiatives and Mortgage Banking, or CLIMB. That's where we engage with CDFIs, lenders, credit unions, independent mortgage banks, investors, and others, even home builders, to build products, programs, and delivery systems that benefit low income and minority populations. And we've got a team of folks who've been delivering credit to underserved communities for many decades. So we bring that experience to bear. The second other program that we do is our equity DPA program and down payment assistance facilitation. And that's really it's a SPCP down payment assistance solution. And we might get a chance to talk about it more, but you can see some on our website. And we're happy to be here as one of the partners who built SPCPtoolkit.com with the Mortgage Bankers Association and National Fair Housing Alliance. So we're helping to get these out throughout the market.
Okay, Gabe, well, thank you very much. I'm going to stop sharing because we are going to get down to business. Okay, Olivia, we're going to start with you. So as you mentioned, you've been working with lenders, specifically with SPCP and a lot of other issues related to fair lending and just lending in general for more than a decade. Can you start us off with a basic overview of SPCPs and their history?
Absolutely. Thanks, Laird. The starting point here is that the ACOA, like other federal anti-discrimination statutes, prohibits discrimination in credit transactions for particular reasons, including race, color, and others. That prohibition means that a lender can't consider any of these enumerated factors without engaging in unlawful discrimination, except that the ACOA also authorizes, quote, special purpose credit programs, or SPCPs, as you'll hear us refer to them. The congressional record explains what Congress meant by authorizing special purpose credit programs. They were specifically designed to prefer members of economically disadvantaged classes and to increase access to the credit market by persons previously foreclosed from it. So that's a quote from the congressional record. So in other words, what this means is that special purpose credit program provision of ACOA provides an avenue, a statutory avenue, for offering preferential treatment that would otherwise be unlawful discrimination. But the key is that there needs to be specific requirements that are met that are enumerated in Regulation B, which is ACOA's implementing regulation. And though ACOA authorized special purpose credit programs back in the 1970s, market studies and anecdotal evidence have suggested that there are very few of these programs that have been established, although, as Laird mentioned, there have been instances where special purpose credit programs have been implemented by lenders, both in the mortgage context and outside of it.
So what's changed? Tell us more about why they're front and center right now.
An important question, because again, they've been available to lenders since the 1970s, but they're really at the forefront of the national conversation right now. So what has changed? Until recently, the requirements of Regulation B with respect to implementing and documenting a special purpose credit program have been pretty slight. There hadn't been much regulatory guidance on the subject, although there was limited guidance that did clarify some of the requirements. And there were very few judicial decisions from courts explaining what the courts interpret special purpose credit programs to require. There had only been one lawsuit by the government challenging a special purpose credit program that was in the Third Circuit, and it provided some guidance, but there just wasn't much out there. So there were a lot of questions. Additionally, other federal anti-discrimination statutes overlap with the ACOA. As an example, the Fair Housing Act. It's particularly relevant to the issues that we're going to be discussing in this program today. The Fair Housing Act, unlike ACOA, does not include language permitting preferential programs like special purpose credit programs. And so there was uncertainty in the industry as to whether implementing a special purpose credit program in the housing context would make a regulator question whether that program violated the Fair Housing Act's prohibition of considering race in any way. So given the limited regulatory guidance from the regulators enforcing these statutes and from the courts, because there had not been litigation challenging special purpose credit programs, again, hearkening back to that they were little used, it's a circle that fed upon itself. And so there were a lot of questions. That changed significantly in the past 2 years with the release of substantial guidance from the federal regulators, not only explaining and clarifying the requirements of special purpose credit programs, but also providing an endorsement for good faith programs that lenders establish with good faith purposes in principle. So we've got the CFPB releasing an advisory opinion in December of 2020. HUD then a year later issued important guidance for this group in the mortgage context, explaining that HUD's view was that special purpose credit programs were instituted in conformity with the requirements of ACOA, and the legal requirements explained by Regulation B would not generally violate the Fair Housing Act. And HUD's Office of Fair Housing and Equal Opportunity actively encouraged lenders to help resolve inequities through special purpose credit programs. So that was a really big piece of guidance for mortgage lenders that might be considering these programs. Then you've got FHFA releasing guidance at around that same time, December 2021, also endorsing special purpose credit programs as a potential remedy for disparities in home ownership. And then we've got the interagency guidance from the agencies in February 2022, again, hearkening back to the earlier guidance and suggesting that lenders should explore opportunities for special purpose credit programs where appropriate, and also in conformity with applicable safe and sound lending principles. So there was a lot of guidance that clarified from the regulatory perspective what the requirements around these programs would be, and also providing this endorsement in principle of what these programs in good faith are intended to do. Then we've got additionally in June 2022, we've got the GSEs, Fannie and Freddie, that released their equitable housing finance plans. And those plans endorsed special purpose credit programs as a strategy. It's highlighted throughout both plans. I mean, this is really important, especially for institutions that operate on a strict originate and sell model. Fannie Mae's program specifically states that it received comments encouraging greater liquidity for mortgages originated with special purpose credit programs. And its plan states it has a goal to, quote, create opportunities for increased participation by clarifying or changing the selling guide so that loans can be saleable to Fannie Mae. And Fannie Mae also stated that its objective is to make its purchase of special purpose credit programs, and this is a quote, as routine as any other loans we currently buy. So that's really important, again, for institutions that don't have the ability perhaps to hold loans in their portfolio. And so we've also, as Laird already mentioned, we've been having a national conversation about equity and inclusion, especially with regard to the persisting home ownership gap. So all of this collectively has brought special purpose credit programs to the forefront.
That's a lot of fantastic information, Olivia, and you can tell you have decades of legal experience and policy experience with this. Gabe, you too, like Olivia, have been, helping lenders, bring innovative credit programs to the forefront for decades. And you are a key, probably what I say, one of the main architects of the MBA's SPCP toolkit. Can you kind of give us the lender perspective? What trends are you seeing and hearing from them in response to the endorsements that Olivia talked about? And just, overall, how do you think SPCPs are fitting into the trends the industry is seeing today?
Yeah, thanks. And kudos to Mortgage Bankers Association and NAFA for, doing the work on the advocacy side to get some of those releases that Olivia just mentioned. Also would say all of those regulatory guidance posts are curated on the spcptoolkit.com, or they're also on our website and easy to download if folks would like those copies. I would say that we're starting to see more and more interest around this. It's tough in this environment to get excitement when people are, performing layoffs and many lenders are shrinking. But that said, when you are looking at areas of opportunity, this is the blue ocean, as I like to say. So, the red ocean is everyone's competing for the same groups of people who have benefited from these systems and credit programs in general in the past. And where we see the gap is in communities of color. We also see that that's our growth market. So I think people are starting to look at this from a business perspective, in addition to all of the social reasons why it makes sense, and say, where are we going to go next and how do we grow? And that makes programs that are focused on underserved communities more popular. And so, we are definitely seeing a major uptick in interest. And I would say on spcptoolkit.com, we've seen thousands of visitors, and that's only been industry folks. That wasn't really shared with the public. That was really just shared with MBA members by and large. And so, webinars like this and others that MBA is continuing to hold really gets the word out there about SPCPs. And so when you combine, this regulatory opportunity with the market being challenged and needing to find better opportunities, I think that, it's getting more and more attention.
And Gabe, I mean, in general, I mean, I feel like lenders for the most part are enthusiastic. Is that what you're seeing too?
Yeah, I think it depends on the different parts of the institution. So I've seen a lot of enthusiasm on the sales side, on the CRA folks for banks, or diverse lending, or emerging markets for other lenders, and that you see a lot of excitement around it because they understand the opportunity and they're closest to working with the target populations that will benefit. There's still a lot of education on, in other parts of these institutions, whether that's leadership or credit policy or operations, underwriting and credit risk, that need to be socialized in the conversation and get comfortable. We've seen a fair amount of time go into that as we facilitate lenders going through their decision process and their planning process, right? And you need all parts of the house, and different parts of the house are more excited than others. But at the end of the day, I think I have seen that all of them have been really excited to reach, new numbers, new goals, and new populations, and do something they can be proud of as well as a lender.
Well, and I think that's, the bulk of what we're going to talk about is going to address a lot of those different pieces and how we engage different members of the house and in a lot of different ways. You kept saying the O word, opportunity, right? And so I did want to share this data because when we talk about special purpose credit programs, and again, a lot of what I'm going to offer today are is insight into how we incorporate data into special purpose credit programs and all the different places where it really can be the backbone of the direction and the design that they take. So I'm going to start by quantifying that opportunity though. And, if nothing changes, okay, with all those trends we talked about, our forecast for purchase opportunity over the next 5 years, so that's 2023 to 2027, we are forecasting $2.86 trillion. That's 30% of the purchase opportunity over the next 5 years. $2.86 trillion will go to minority households. Okay. One thing to keep in mind when we're looking at this market that's kind of going down is the fastest growing markets are these markets. And so as we look at this, this table that I have up here, you can see a lot of different little highlights here. And the reason I pulled this together was to prove a couple points, right? And one is that $2.86 trillion looks really different in each market. And so that's one of the things that makes data so critical, is because we have to always be thinking about the size of the opportunity, the uniqueness of the market, how it's concentrated, how it's, what the competitive field looks like there in terms of lenders. And so that's something that you'll hear frequently as we talk today, which is the importance of being very targeted and strategic in how you look at what you're building. And the other thing I want to bring up here, when you're looking at this $2.8 trillion, I said that was if nothing changes. One of the things that's so exciting about special purpose credit programs is that they really are and could be, if done correctly and done the way that they're intended to, following the guidelines of the written plan, and being strategic, data-driven, all of those different pieces, this could be a blueprint for how we do strategy moving forward. Other programs, other products, other initiatives. One of the things I think that the industry needs to think about in order to change this, these decades of this decreasing or widening homeownership gap, we have to do things differently. And so that's, really that $2.86 trillion. If you start taking that homeownership gap and you say, okay, let's cut it down by 2 points, 4 points, 5 points. It's 29 percentage points difference between households of color and non-Hispanic whites, 29 points. Well, if you chip away at that 2.86 trillion becomes 3.2, 3.5, goes up and up and up. And so when we're worrying and thinking about this lack of growth, this is where we should be putting our attention. So before I dig into, we're going to spend some time again digging into special purpose credit programs, but I want to go back to something little Olivia was talking about, and that's that at the end of the day, special purpose credit programs were created to help a group of people. And so if we think about that as the backbone, we need to realize that really this whole process begins by figuring out and identifying who, in terms of groups or communities, whose needs are not being met. And whether it's by your institution or the industry, that is at the core of where this special purpose credit journey begins. And so that's what I'm going to spend some time on right now, is just, how can we utilize data, and what are some of the best practices for using data specifically to start working on that determination of need, or answering the question, is there a need in your market and who has the need? Okay. And so, just kind of some big picture things, what we need to think about is, and I'm going to show some examples of data sets, but you need to be thinking about, how are the demographics changing? How will they continue to change in the future? So that's one of the key pieces that we're going to hear today. This isn't just about today and what happened yesterday. This is about where things are headed. So when you think about what you're building and you think about evaluating it and supporting it, we have to be thinking about how we support it through change. And so we're going to look at those demographic pieces. Obviously, there's a big piece, how do home ownership rates and access to credit differ between these groups? So on one hand, you have to look at the actual, trends of the different groups, and then you have to look at differences in credit access. And then obviously another thing that we're going to spend some time on is, are there patterns that we see? Are there patterns in, segments that are consistently underserved or unfairly served? And if I think back to that line graph, I'd say that the resounding answer is yes, there are patterns. And so that can give us some direction in how we start thinking about where and with whom we might want to create one. And then we have to also look at, are there different types of patterns, not just patterns in groups of people, but patterns that impact specific communities and neighborhoods. And then at the end of the day, the concept of gaps in coverage really is taking all of those pieces, putting it together and saying, geographically, demographically, product-wise, where are the gaps and how well we're able to help this group of people. And so I pulled together some little bits and pieces of data just to sort of, start illustrating where one could find this data. And again, no one metric or indicator is really adequate for describing this determination of need. And I think one of the things you have to think about when you go into this process is to keep an open mind, right? I mean, it'd be very easy for me if I wanted to find a need to come to the table with data that proves my need, because there's so many pieces of data, whether you're looking at, census data, that's available through the CFPB, whether it's, and this is going to be a unique year too, because we're getting brand new decennial census data to work with, whether it's the American Community Survey data, that they have a 1, 3, and 5 year survey. And that information is usually what lenders utilize quite a bit to start looking at, issues of housing, households, population, income. Again, a lot of the things you see on this chart. And it also requires bringing in, still at that demographic level, not just sticking with those more traditional sources, I think, but looking locally, looking at what you can find that is even more granular about your communities. So in a way, data isn't one size fits all, but there are some key pieces to look at. And if I were going to point those pieces out, it would be home ownership, households, and distribution of households. And so what I mean by that, when you start by saying, okay, the market I'm going to use here is Memphis. Let's look at Memphis for a minute. The overall home ownership rate in Memphis is 62.6%. If you look at the what we would call the penetration rate, or the distribution of households, what you can see here from this chart in the middle here is that when you look at household concentration by race and ethnicity, 46.5% of households in Memphis are Black. The national average is 13.3%. So if you're a lender and you're in Memphis, chances are this is a really important borrower group to start thinking about. On the other hand, though, if you look at demographics in Memphis, you can see that the Hispanic population or percentage is much smaller. And there are markets all over the country, like if we looked at Dallas or San Antonio, Miami, where that would completely switch and we'd be seeing a different, a different picture. And that, going back to that chart from earlier, that's that need to start looking at this market by market. In Memphis, 46.4% non-Hispanic white against the national average, or the US non-Hispanic white household concentration is 66%. So you can see in general, when you look at Memphis, 53.6% of the households in Memphis are minorities. 34% are, the same percentage for the US is 34%. This is a huge number. This is the evidence that I would say makes this a really relevant conversation, whether you're thinking about inequity and righting a wrong, or you're thinking about growth. So that household concentration is really important to think about. Another thing that we were looking at, though, if we're at the end of the day, what do you need to know? Well, you need to know that final outcome. How well are we filling the credit needs for a particular population? Well, we know that there are a lot of factors that go into the homeownership gap, right? There's access to credit is certainly a big part of that, and you will be able to see that in application activity. But there's also a trust gap, there's an education gap, and kind of now there's also an inventory gap, if you will. It's kind of like a little tiny fourth factor that we have to consider, probably more than we did, maybe 5 or 10 years ago. And when you think about that, that outcome, how do you, again, not using one metric, but to encapsulate a lot, how do you identify a gap? Well, that is, I think, the best outcome to measure is the homeownership rate gap. And so if you look at Memphis here, you'll see that again, 62.6% homeownership rate overall. Non-Hispanic whites, 78.3%. That's a really high homeownership rate. And then now if I'm going to look at these different groups, based on the size of the Black household concentration in Memphis, that's going to be the group that if I'm trying to increase minority lending overall, I'm going to focus on. And that number is going to be the homeownership rate for Blacks is 48.6%. So that is a homeownership gap, a rate gap of almost 30 percentage points. That's really big. So, so that's where I'm going to stop for a second before we go deeper, because one of the things I want to throw back at our panelists is really this discussion about how specific or narrowly should lenders start thinking about defining the target group, and at what point in the data journey do they need to either become more defined or stay more loosely defined? And I'm gonna toss that one to you, Gabe.
Well, I would say, we would love to see more people-focused SPCPs out there. But what we are seeing, which would be, determined eligibility based on someone's HMDA category or their race or ethnicity, as opposed to the areas and geographies. But areas and geographies have been I would say, the primary choice of lenders so far. And we're starting to see some hybrid models. And those that have chosen a geographic base also have, I would say, in the monitoring plan, and I'll circle back to what that means, but in their monitoring plan, if they went geographic based and they're not seeing results, then those plans are ready to engage a more people-based eligibility criteria for the program, which would expand it then beyond those geographies. So a lot of times what we're seeing here is some sort of a definition of majority minority census tract that can be split in a variety of ways. It's really important to know what minority categories make up that concentration in the census tracts as well, so that you can align your sales strategy and your language competencies and cultural competencies to reach those folks. And having that geographic focus. Also, I suppose I would say an early caution or best practice that's floated up has been to be mindful whether you are requiring people to purchase in that census tract. So I would say, for those that we've helped to do a census tract based program, we point at the data points of current address or subject property. And so those are two data points within the system, which would all tie into your monitoring plan that would trigger the eligibility. And so that allows people to be mobile. And what you don't want is to say to a minority population, we'll help you, but only if you buy in your neighborhood. And so that's the early caution, and the best practice is to think about that more broadly if you are going census tract based. To think about maybe being your current address or where the subject property is. Folks that are CRA banks and lenders they're more accustomed to looking at these from an LMI census tract perspective for CRA eligibility, as well as LMI status of a consumer. So this, if you're a bank and you're into CRA lending, this tracks really well with that. But there are different tools when you are triggering SPCP. And I would say for those folks, another caution or that's really risen to the top is not to think LMI equals minorities. And so don't make that mistake. And we can see the results of CRA, and we still have the homeownership gaps that we have. So low income or income focused programs only are not likely to be highly successful with minority groups. And the other way to think about that is for all of the minority folks that are not yet homeowners, starting with the highest of income among them, they should all be homeowners, right? And so folks should be targeting everyone who's likely to succeed. And that includes people up the income spectrum who are still living in a biased world and are often first generation homeowners. So it's important to have SPCPs that reach them.
Well, and I think that that's a great segue into a real life example I'm going to ask here in a minute. But I think one of the things that, again, going back to that market-based approach, you think about a market like Memphis, in order to have every household, I think everywhere we go, we want to have an impact. So in no way am I saying just because in Memphis, there's only 3.9% household concentration, that doesn't mean that increasing the home ownership rate for that 3.9% of households isn't important, right? But what we're trying to help, again, as we go through today and we start thinking about balancing doing good work and helping communities work with sort of a business case, sometimes that targeting comes to does involve some efficiencies, right? And so if you think about a market like Memphis, like I said, this the fact that it's 46.5% African American, there's probably a lot of different paths you could take in terms of people-based, place-based, those different things. But I'm going to ask Lindsay for a second, because Lindsay and I are both in Iowa. And I want to hear your experience. It's really a really great example of how important it is to look at the type of market you're in, even at that place when you're figuring out what design you're putting these, on these special purpose credit programs.
Yes. So when Green State started our affordable home loan program, initially it was not an SPCP. We were looking at census tract data and really wanting to lend in LMI areas. And to Gabe's point, our program really focused on individuals that were currently living in that either wanted to stay or move out of. And then we also had a component of individuals that were not in low income census tracts, but wanted to move into those neighborhoods. So that was our qualifier, right? Well, as we began to look at the data and the people that were accessing our program, we quickly realized it was not being accessed by minorities. Iowa is 4.3% Black and 6.7% white. So even in those LMI communities or individuals moving in, we still were not hitting the target. So for us, our goal was to lend $1 billion to people of color over a 10-year timeframe. We were not going to be able to do that by leaving our program census tract based. So for us, the best way to hit that target and to really be intentional about targeting people of color was to flip and to do a special purpose credit program that would cover, as the first qualifier, people of color. And then from there, we are looking at income. And we have looked at like 80% of the area median income for the counties that they're in. And that really has helped us to get our program on track to meet our goals, and to really be intentional about the lending, because as I'm sure most of you are aware, Iowa is just not, we aren't growing our minority population as quickly as other states. And so for us, having a people strategy was really key in making sure that our program hit the goals that it was set out to accomplish.
I think that's such a good, I don't want to call it a story because it happened, but I think it's a good narrative and a good example of how important that is. Kind of moving around our agenda here a little bit, but I do want to ask one quick question legally of Olivia. Before we move beyond the people versus place in hybrid discussion, are there pros and cons from a legal perspective? You know, is one better than the other from a risk perspective?
Yeah, and from the, there's no one size fits all answer for this question. And we've just heard, both with the example that you provided in the data and the example that Lindsay provided from her own institution, some of the considerations that come in to play depending on the particular market that you're focused on and that you're operating within, and your institution's particular goals. But, as a starting point, it is, it's not disputed that as a legal matter, the CFPB, the agencies, they have endorsed special purpose credit programs that are focused on extending benefits to persons in particular neighborhoods that are defined by, a particular characteristic that might be covered by the ACOA, such as majority minority census tracts. And from the legal perspective, this isn't surprising because, of course, certain fair lending claims, namely redlining claims, do focus on challenging a lender's performance in making credit available based not on the race of the borrowers, but based on the race of the residents of a particular area. And of course, the Department of Justice and the agencies have brought claims of redlining under both Democratic and Republican administrations, but it certainly has been a focus of this current administration with the release of the redlining initiative that the DOJ has implemented and has been acting on. But for any institution that's contemplating a special purpose credit program, when you're considering how to define that class of persons, you're going to want to focus on the requirements that are defined by Reg B. So you've got to have the results of an analysis that support a determination of need. And so your needs analysis is going to have to support either that geography-based definition or that individual-based definition. And you're going to have to take into consideration the demographic makeup of your particular market. We heard Lindsay explain, the situation in Iowa, another similar example just to jog the imagination, if you're operating, for example, in California, there are many metropolitan divisions and statistical areas in California that don't have any majority Black census tracts.
Right.
And so if your goal is to reach Black homeowners with your program and you've identified a need in that community, it's not going to even be possible to have a geography-based program. So you've got to consider, what are the housing patterns in your community? Are they the success of a program that's based on geography. The Urban Institute released a paper to that effect and highlighted Detroit as an example. Or is your location more of like a melting pot type of geography, in which instance you might be considering defining your special purpose credit program differently?
Yeah, and I think again, when I was talking and doing Memphis, there weren't any majority Hispanic tracks in Memphis. So, and I know for a fact, when you go around the country, whether it's a big metropolitan area or a smaller one, you see that. So we just spent some time on that demographic piece and that end result. But as we're going to be moving into the components of the plan in a bit. But before we do that, I did want to talk about sort of the other side of the determining needs. So we were talking about the demographics. But then, when we start talking about why does that home ownership gap exist, I mentioned that, trust, education, and then also credit gap. Well, you really see that credit gap, part of the logic model in the application and action data. So that's another key source, utilizing, not just 1 year, even though I'm looking at 1 year here with this chart, and I hope everyone can see the chart. Other panelists, if you can't, let me know. But when you're looking at this chart, you can see here that, in the past, we've always talked a lot about denial rates, and I still think they're critical. Like here, if you look at the denial rates in Memphis, you can see that the denial rates for Black applicants are 19.5. The denial rate for non-Hispanic white is 12. So you can see that's a big difference. Or the market, I'm sorry, 14 and 7. And then when you look at withdrawals, it starts to change. And so when we talk about, whether it's a denial, a withdrawal, removed for incompletion, any of those fallout reasons need to be discussed and quantified. And, not just from the perspective, obviously it's really important. And you can see from the charts here, we're comparing the market and the lenders comparing how they're doing to the market, really looking to see, are there any credit gaps that we specifically are seeing? And that sort of fits the idea of, we want to create a SPCP if we're not doing a good enough job. But before we move on to our next topic, there is an instance that I want to make sure we talk about. And Jason, I'm going to toss this question to you. When we were preparing for this, we were talking a lot about what would lead a lender to wanting to do an SPCP. And what first comes to mind is the lender has a gap. Can you give us an example where the lender data might be a little less relevant?
Great, happy to do so. And I do have to start out with a disclaimer that Huntington, like a lot of large banks, have paid attention to the regulatory guidance regarding SPCPs. I can't speak to Huntington's particular SPCP plans at the moment because they're non-public, but I'm happy to share my personal views on this call, which I will do. So we're taking a look at lender data that's less relevant. One of the things that I believe is important to consider is before you even get into the SPCP topic, you sort of have to do an inventory of what you already do today. There often can be an assumption in this environment that the SPCP is sort of the cure-all for lending ills, when in fact, there could be things that the lender is doing today that would prohibit them from serving their community effectively. So the HMDA data that Laird has here on the screen, it may look like your data, but there may be different root causes. So for example, you need to understand the product offerings that you currently have today. Are the product offerings themselves designed to serve all areas of the community, or are they specialize somewhere? What's your distribution strategy look like? Do you have LOs that look like the communities you want to serve? Do you have pricing that makes sense? Do you have compensation for the LOs that encourages them to originate certain types of loans? Do you have the distribution channels that you should have? Or if you're primarily phone-based or you're primarily internet-based, do you need to have LOs out in the field trying to make connections? Those are things that I would consider, because before you even get the threshold question of, do you need an SPCP? An SPCP isn't going to fix very basic distribution challenges, staffing challenges, or other types of challenges that a lender might have. And that could be rectified, frankly, more simply than putting yourself through an SPCP. It's a lot of work to do an SPCP well, and you're certainly going to have some more regulatory scrutiny by doing it. Hiring LOs and putting them in the right areas may be a simpler strategy to get where you need to get to. And then the other thing I would just say is that as a lender, when you take a look at your data, it can be very easy to jump to a conclusion that you have an issue if you just simply say, well, I also read about this in a particular industry study. There are all sorts of industry studies out there that are very general in terms of there is a need, and there's nothing wrong with those studies. The studies are absolutely right. But as other folks have pointed out here today, where you serve is pretty darn important in figuring out what your specific need is. And so I just would caution jumping to conclusions to say, okay, we deny XYZ group at a higher rate, and the study says that, oh, that confirms that across the country XYZ group is denied at a higher rate, therefore we're going to do this. I think there are a few more intermediary steps in there, the ones I just mentioned, as well as some others I'll probably get to later, that would make a lot of sense before we're jumping into an SPCP.
I think that's a very interesting point, and it's a good segue as we start talking about, and we're going to move a little bit now away from the determination of need and really get into the nuts and bolts of that building the SPCP. What's the design look like? But before I do that, the data on the screen is really sort of, at the end of the day, when you're determining the need, what we're really looking at as, how balanced is how balanced is housing and access to credit. And I think you can take a lot of different data pieces, but at the end of the day, you're looking at the community, the market, the application and housing data points, and really figuring out whether or not there's a need. In some ways, it's a critical step, but it is, I hate to say it, the easiest step, right? Because at the end of the day, what we want to do is we want to see things change. And so with that, I'd like to kind of move this into the plan design, and just because of some of the Q&A that's coming in, we're going to get into some questions about, how do we make this, how does this fit into the business unit, mission versus business outcomes, and all of that in the next section here. So Gabe, can you start us off with a nuts and bolts overview of the interventions and components that we can see, just like, kind of a quick overview?
Sure. So common interventions, as we think of them, or what you can change about your credit product offerings that would create an SPCP and would therefore be able to build out the argument for providing an advantage to the target population that you have determined the need among. So most basic ones are rate discount, so a discount on the loan, right? Or a credit on the cost. So in other words, a discount of the costs for the loan. So that can be your closing costs, and then a discount on the rate, so a permanent rate discount. Sometimes could be temporary as well. Down payment assistance is obviously a big one that folks use if you have those resources. And in fact, what we're seeing, some of the innovations and some of the things that will be tested and learned from among the GSEs in this world of SPCPs really highly involves down payment assistance and credits as well. Just to rattle off some more sort of guideline changes that you can make that could advantage that particular group, that would be loan to value, CLTV limits, thinking about how you can layer with other products and programs. Debt to income ratio is obviously one of the biggest, it is the biggest reason for denial by and large. FICO minimum scores, right? That's a big one. Borrower contributions into the transaction. And then other things you can do to enhance affordability if you're not already covering the costs or crediting those in some way, would be to have lender paid mortgage insurance or no MI Oftentimes for a purchase product, obviously, we're talking about very high LTV or above 100% CLTV.
There's a lot of options.
Lots
Right?
of options. Yes, yes. And
A
the
lot of
GSE
options.
will remind you, and I think Olivia said this earlier, or someone did, that you can create SPCP programs within the credit box of both
Right.
GSEs today and within the credit box of a variety of secondary market outlets. It's really, what would you do to enhance the program? How does that enhancement to the product benefit the population you've determined the need among? And and then how does that differ from your other products and programs? Is it in fact something new and different?
Well, and I think that's a great point, and it really kind of confirms what Jason said too. It's like, how does this differ from what we're already doing, right? I mean, the last thing we need to do is, as individuals, create multiple programs that are meant to do the same thing, but also looking at in the market who else is doing something similar, like competitors, other nonprofits, like what else is there that can make this innovative and different? So those were like very nuts and bolt pieces, but I want us to talk a little bit about, how we can take, quantitative data, which again, a lot of times when we're working on these things, we'll bring in everything on the SPCP side from, the profiles, like really digging into the denial reasons, and understanding more demographics and details about the loans that are denied, really getting down into the details of that. We'll bring in a lot of the details on borrower income, age, occupation, at the outset, just really thinking about all the different pieces that we might want to bring together, so it's like a comprehensive look at building the program even before you start putting out those bullet points. Who are you involving and bringing into it? So I want to start with something that, I'm excited to finally bring Mosaic into this discussion. And Gabe, you said this in our practice sessions or our planning sessions, how important it is to do things at inception. Mosaic, you have an incredibly successful sales team. And at the end of the day, the salespeople who are out there connecting with borrowers. Can you share with us how important it is, in terms of at the outset of design, to bring that expertise of your team in, and really, what does your experience tell you about how to help your institution create a better, stronger SPCP?
Thank you for bringing me into this, Laird. I feel that the boots on the ground are probably a huge piece of this, because the moment you're establishing who your audience is going to actually be to get your credit program executed, I feel like your sales group really should, first of all, be on board, right? Secondly, be able to articulate the mission and the goal to the consumer. And then third, cultural relevance of that sales team is really going to make the difference in execution. And when I say cultural relevance, much like Lindsay said, they're out there purposely trying to recruit people that look like the community they're trying to serve. There is a huge gap, I feel, a lot of times, because there's not a lot of minority LOs a lot of times that aren't in the call centers and things like Jason said. If you're behind the scenes on the phone, how do you relate to these people that are in the community and convey the help that the institution is trying to provide? And also being able to more or less meet that consumer where they're at in that very moment in their life, because there is going to be some relevance between maybe your sales team coming from that same demographic or geographical area because they grew up in that neighborhood or something of that nature, to know how perhaps they build their finances, their experiences, and things of that nature. So it is very, very integral into first choosing what you're wanting to accomplish and then mirroring your sales team to make sure that they really meet that need that you're trying to drive home.
And you know, if you were going to give, I mean, you guys have been extremely successful in a difficult market. In terms of, you know, barriers facing people of color, what can you share about those? Like what you've learned from that perspective, you know, if, at the individual salesperson level?
I feel once I started building a team of, I wanted all kinds of people on my team, whether it be male, female, African-American, Hispanic, Indian, like we're very, very diverse, which I'm super proud of for starters. But I tend to learn from my team every day, you know, about those experiences I didn't even have, or my family hasn't had. You know, everybody has a different walk of life, let's say, as far as employment, how they save money, how they spend money, what is culturally acceptable, you know, to the family and how they build their household. It's major. It really, really is major. And I think when you're able to get out into the community and step away from the black and white paper guidelines, okay? We all, yes, I have to live by guidelines because it's what governs how I can grant loans. But when you step away from those guidelines to meet the humans where they live, let's not forget about that. They're human beings. They're not debt to income ratios and reserves and numbers. They're people. So how do we serve those people better by understanding what they're really looking for and going to? It's something that homebuyer education, being more vanilla on the guideline side, can't teach a home buyer, and it won't teach your sales staff either. They have to almost instinctively have a bit of that when they come to the table and be able to articulate that to the consumer, because it will also help you, like Jason said, whether you get a special credit program going or you are tweaking the programs that you already have on the table to perhaps be able to either be successful in a market like this or execute better in the community. You need to have that there already. And then as a lender, you can literally build that at the beginning. Gabe would like hit the nail on the head with that. Before you run off and establish a program that can't be executed, you need to look at your staff and kind of pull that back and who's on board and who can deliver.
Well, I can tell you that I've spoken to all four of you lenders, and you all have really interesting insight on this. And so, you know, I want to just kind of let this conversation go because I think it's so critical to hear, you know, your thought process as you go through, you know, the development and the steps you need both intellectually and, you know, as an organization to create this. So the most recent person, Evan, you just got through putting together a very comprehensive, unique, multifaceted plan. Even if this is a long answer, can you kind of wrap it into, put a bow on it for us on terms of how you incorporated so many different pieces to come up with something that worked for you?
Yeah, later. I'm happy to do so. And I shouldn't say we're there yet, right? We're in that very fun yet important stage of verifying our data set. So we've done a lot of internal research. We have worked very closely with Laird and iEmergent to also pull together some data to really help us confirm what we thought we knew from our HMDA filings, from our CRA performance evaluations, from our fair lending analyses, you know, a multitude of different sources inputting data. But I think as we think about the SPCP proposal that we have, to just give folks a fairly quick overview, we moved into the Columbus, Ohio MSA as an institution in 2015, but we really emerged with an acquisition of about $1 billion bank into the Columbus marketplace in 2018. And so since then, we've been kind of building the sales team, building the bank, building the brand, a couple of LPOs, a number of different facets to try to build First Commonwealth in that marketplace. But if you're familiar with Columbus, it is a very bank saturated market. And there's a high number of financial institutions who are competing for the same opportunity, the same business, the same customers, right? And so I think it's become an interesting marketplace because it's still a remarkably low homeownership rate amongst African Americans and amongst low income populations. So when we looked at our SPCP, we did a few things. I think the first is number one, you've got to bring your internal stakeholders together. So this isn't just one department, one group of folks. This is a cross section of folks from corporate, which I sit in the corporate arm of the bank. This is a cross section of our compliance team, our legal team, our mortgage banking team, both sales and operations, product management. A lot of the folks that Jason had referenced would be the same folks I would reference to make sure that we all understand where the opportunities are. We all mutually agree that there's shared opportunity and importance to get there. And then I think, the second piece really is getting your external stakeholders. So I strongly recommend, it's not required, but I would recommend that you work with outside counsel, particularly somebody like Olivia at K&L Gates, who has a subject matter expertise to really verify what you think you know, right? I think Jason made the joke a little earlier. Don't assume you know what you know, right? You got to point to the data and make sure that you really understand it and have somebody to verify it, to then move into kind of that implementation phase, which we're not quite there yet. Expect to be there probably here in the next 60 days or so. But what we came out with was kind of a two-pronged approach. One, very focused on African-American borrowers. Columbus boasts a meaningful African-American population, which is sorely underrepresented in home ownership rates in Columbus, as well as also a geographic focus, which is a bit of a nod to the demographics of Columbus. So don't presume census tracts are the cures to your ails, right? Or the opportunities of them themselves. But with respect to Columbus, Ohio, specifically Franklin County, there is a direct corollary between low to moderate income census tracts and majority minority census tracts. So there's a lot of overlap there. So our SPCP, as it's drafted today and hopefully remains as such, we'll find out here over the next week or two, is to try to tackle both LMI census tracts as well as African American applicants. And so I think when you're thinking about that, the third piece, which we haven't got to yet, is the importance of wrapping in your external stakeholders, right? So I think Mosey pointed to the importance of homebuyer education, so working with the nonprofits, the HUD certified counseling agencies and counselors, your realtors, your realtists, and other real estate professionals, to make sure that you've got that product information out there, that they're aware of how this product is different or this resource is different than what's available in the status quo, so that at the end of the day, you can produce the real results and build those customers, build that business opportunity, and ultimately win those relationships that will help transform communities and individuals for years to come.
Well, I think this shift of, I've been looking at the Q&As, the questions that are coming in, and it's a perfect segue into our next section of this. I'm gonna, bring Rob Crane into this finally. Rob, you work with a lot of institutions, right? I mean, DPR and not just lenders, but other organizations in the housing space. And I think that the questions are all kind of centered around that same question: is how can this fit into our business model? And I know everyone has some thoughts on that, but do you think that there are still a lot of organizations out there that are really hesitant to start thinking about SPCPs because of that? Rob, you're muted.
Sorry about that. I was trying to make sure we didn't have any background noise. Forgot. So yeah, Laird, we do see that. We do see some hesitancy, not specifically just SPCPs, but just SPCPs and down payment assistance. And I guess in a single word, the overall reason would be complexity. It brings a level of complexity to transactions. It brings complexity to organizations. We all know that originating and closing mortgages is a manufacturing process. It adds complexity to that. So, but first of all, we see lots of lenders that are very committed to this business. And we know that you can do well while doing good. But when you look at the numbers, and one way of, I guess, looking at this is, you go to any provider of down payment assistance website, whether it's a state housing finance agency, local HFA, municipality, almost all of them have their list of participating lenders. And it's usually a very good selection of lenders and a mix of local, regional, and national lenders, both IMBs, banks, credit unions. And then as you move around the country from one market to another, you'll see some of the same names, obviously the bigger national lenders. But when you compare the number of lenders doing that to the, 20, 25,000 mortgage lenders out there, it's still a relatively small percentage. So the other thing that we hear working directly with lenders, and we've been doing this for almost 15 years, but some of our tools include consumer-facing module to help lenders start conversations with prospective borrowers. It allows them to answer 6 or 7 questions and see if they're eligible for any of the down payment assistance programs they offer. And among our tool set for lenders, that's actually the least used tool. And when we ask why, sometimes, not always, but sometimes we get the answer that, well, we want to have the competency to do down payment assistance programs when we have to, but we don't want to do more than we have to. So we understand the reasons. Again, it's complexity, but are you really fulfilling your mission statement along the lines of helping households achieve the American dream of home ownership?
And Mose, do you think that, trickles down to on the streets from the LOs? I mean, is that a concern at a salesperson level about, these loans, can they make a living doing these loans? How do you work with that?
I think it's always been a huge conception about maybe the difficulty, the time, and let's face it, the effort that has to be put into bringing those things to life from application to close. I would just say it's literally a good thing to kind of jump in head first and not have those misconceptions, because I feel that in let's just take the last couple of years where there's been more of a shortage of availability of homes, right? Interest rates were great, but some of the buyers that wanted the homes, even in maybe some target areas, were not able to get them because of either being outbid, not able to really come in with that infusion of cash to maybe bid over asking price. And now that that is cut out from the market, we have opportunity. But maybe those that didn't dive into offering the down payment assistance or having some type of special purpose credit program, you have this decline in business. And how do your LOs, sales teams go out there and get business? It is, in fact, this specific buyer group that now has the opportunity to go snatch up home because of availability, especially if they're getting some type of program like Gabe mentioned that has some type of credit or something of that nature toward closing costs, or maybe that seller might be willing to contribute now to help with those costs or that rate along with down payment assistance. You can layer these programs to get people into homes and still make them affordable. So having that mindset before getting to this point in the market allowed my team, I think year over year, I'm up 10% on production. So last year I did close more than 100 million. I will close more than 100 million this year. So LOs seem to think by doing these programs and offering it, they'll spend more time and maybe not get income or the volume out on the other side. Even as a corporation, you think, is this worth it? Yes, there is volume to be had if you can converse in the programs, because you're not passing on potential buyers. Those applications are looked at more thoroughly when you have an arsenal of programs and a sales team that has knowledge on them to place them where they need to be. So yeah, I think there's a huge miss, because maybe some of these gaps on this reduction in production would be filled by these specific buyers that couldn't get homes these last 2 years when we were all living the good life in refi-ville with the low rates, right?
Bravo, Mose. That's really fantastic. You know, in a time when so many lenders are laying folks off and reducing, you're producing 110% year over year. That's phenomenal.
And I just hired somebody as well. So they just started in there in training. So yeah, no.
What a great example for all the lenders.
Yeah, I'm not participating in what people may want to call a recession. I'm going to go ahead and live my best life, give people home loans, help people, because it is your give back. But at the same time, man, it is a great opportunity right now that some people just missed out on, to be able to deliver ownership to people that couldn't get in there and even have the chance with a crack at getting the home that they wanted.
If I could just jump in and add a data point to that to underscore that, we've analyzed tens of thousands of declined loans and found that by looking at those loans and applying available down payment assistance programs, about a third of those loans could have been approved and closed. So who's not looking to increase their pull-through rate today?
Wow.
Yeah.
Good
Yeah,
point.
we looked at cash to close for 2021, and there was $42 billion in volume, 127,000 people nationally that had a denial due to cash to close, where they had a home, they had a loan, they had the ability to repay, they brought in all of the rest of their funds that they could, but that was the one reason that stopped them. And so DPA and down payment assistance is terribly important. I know one of the questions was about sourcing for DPA, and what we've seen is SPCPs tend to widen those sources, and we're seeing pilots, among the GSEs in that regard too. Also variances. So if you need a variance for your particular GSE relationship, that is something to explore. And in the SPCP realm, that widening of sources and bringing the borrower down to zero minimum down payment is something that's fairly standard in an SPCP for purchases.
I will say another thing, Gabe, since you did bring that up. The buyers coming in with low to no down payment or cash to close, it did not hamper my team's ability to deliver a quality loan. I wanted to emphasize that from a corporate standpoint. I know that that's important. My company analyzed my HUD score. So over the past couple of years, I think HUD was monitoring about 394 loans of mine. And I think we had 2% delinquency. So we had 8 buyers out of 394 that fell into that high level of delinquency. But that means also, if you are coaching and again, educating, meeting them where they are, they will sustain the ownership. And then generationally, they will continue to pass the knowledge they gain from your sales team down through family. And again, breed that success within minority home ownership. And literally, it will grow it from the inside out.
Well, you guys, one thing that, when we were all talking, again, planning for this, they were fantastic conversations, and I learned a lot. And I learned that, Evan, you were talking with Lindsay about all the different things that can be stacked and done. And, how do you make this fit your business model? And my advice would be, rather than have us go through all of those, which is what I learned from you, is that it's really done on an individual basis. That would be a great thing to talk to Gabe about. I know he has a lot of experience in figuring out how to design all of these components to fit a business model. So give him a call for that for sure. But I do want to make sure we get Jason's opinion on this, because I've worked with Jason in the Convergence Initiative, and he's really a thought leader in the industry. And what can you tell us about, ideas and the difficulty of developing those win-win programs, and how do we, do all the things we're trying to do here and still do it in a way that, these are for-profit companies, it makes things keep moving.
Win-win is obviously the goal. That's easier said than done now in a lot of cases. A lot of SPCP programs or community programs that I've seen involve substantial grants or down payment assistance being provided by the lender. Wearing my business leadership hat, that can sometimes be tough to do, especially if you're portfolioing those products. Wearing my credit hat, there's obviously a lot of review about credit parameters. The last time we closed the home ownership gap was pre-crisis, and that in a lot of cases that was because we as an industry extended credit in an unsustainable way. And while what we're doing here is obviously with better intentions and isn't nearly as kind of I guess the word could be innovative as what was happening back in 2005, 6, 7. I think that still is in the back of people's minds, at least in the back of my mind. Because it's important that home ownership be sustainable. Getting people into homes is great, but if they're out of the home in 3 to 5 years, especially as we look at a looming cycle turn here where everyone's going to see increased delinquencies, that's not an exciting proposition. That's not to say that lending to diverse minority populations is inherently riskier. It's that we're all looking to try new things that doesn't have a track record, and so there's always risk with that. Some things we look at internally within Huntington to help us make sure that our compass is always pointed in the right direction. And Evan hit on it really well. Kind of one of the first things is make sure you have a good group of community stakeholders. And the only thing I would add on to what he said is consider, if you're a lender, how much you can bring that internally into a committee or something else where there's accountability driven from it. And that way you get the right executive leaders to hear what's being said. If you do it informally through breakfast meetings and things like that, you can curate a little bit. If you bring a group of stakeholders together and shine a bright light on it and put the corporate governance around it, that can yield some really nice accountability for an organization. I think it's important to understand how your product is really being used in the market as in addition to how you think it's being used. I think a lot of times people introduce products thinking it's going to be used for one reason. It turns out it's used for another, or it's not really used deeply at all. Trying to really get some good use cases, talk to consumers, talk to LOs about that is critical. I think training your loan officers in programs like what Rob and Gabe offer, offering state HFA, those are critical components when you're thinking about economics associated with this. Maybe you can't fund a DPA on your own, but there's a ton of DPA dollars out there in the industry that can likely work with your programs. And it's important to be creative and don't get stymied just because you may have limits internally. I think we should always keep our idealism for systemic change at the forefront, but not be dissuaded by incremental success. We don't have the home ownership gap that we have because of 1 or 2 years worth of issues. It's a decades old issue. And so closing the gap may be something that is done basis points at a time. What lenders need to be good at is cutting the strings on things that aren't accruing. You need to find the things that are working that you're doing and then invest more heavily in those to accelerate the change. And then you need to be sort of ruthless with the things that aren't working and say, you know what, we're gonna focus on what we are making an impact, because no matter how big you are, no matter how small you are, you can't serve everybody. You need to make the change where you can make the change and build from there. And then the last thing, and this is reemphasizing points people have already made, loan officers are a bastion of information. I sometimes give them grief as the only thing they're good at is selling a rate. That's not what a good loan officer can do. A good loan officer can tell you why your product works, why it doesn't, what your competitors are doing, what your stakeholders need, finding the good LOs that have been through cycles and have been through challenges and have nevertheless remained successful, worth their weight in gold. And then just closing, I think what I would say is this initiative is designed to expand credit availability. Like I think someone mentioned blue ocean, I call it blue sky. Like this should be accretive volume. One thing to just think about that is we're going to run into people, I think, who are going to understand like, okay, I'm maybe because I heard of this SPCP, I think I can afford a mortgage now. You know what? They may be able to afford a home ready or home possible loan. They may fall into that and they just never thought of themselves as homeowners before. Through convergence, I mean, that is something that we've heard is that there are still a ton of gaps in terms of awareness around what you need to be a homeowner. So as you're introducing any new product, and in this case, an SPCP, it's important to continue to monitor sort of the halo effect. You may see pickup in other more standard loan offerings that you have, and you may discover that part of what you need to do better is to be in the community educating people, not necessarily just offering new products and programs.
Well, and I don't want to, I do want to just add a couple things, and that is that there again, we are going to talk a little bit about the role of evaluation, because everything we're talking about is you have to make sure it's working well. So really we've got two big topics left. And that is, we can design it, we can, find the right person, design the right program, and then we could go right to the evaluation and see if it's working. But in doing that, we have to talk about something else, and that's how do we make sure all the different pieces are in place so that it's successfully supported. And what I just want to add, I'm not going to go into the data because we have so many good questions I want to get to, but what we've seen really, not just with SPCPs, but just in general, is lenders having strategies that don't work because the comprehensiveness or the 360-degree nature of what it means to have a good program or strategy in place, there's a missing link. So for example, when we first started talking, let's see, about 18 months ago, we had forecast data. We could help lenders pinpoint where they needed more, where there were gaps, what they were missing, where they were going to be missing. And they said, well, we need more information. We need information that's tactical. So we added, real estate agent data and listing data. Well, that was really helpful because then now they have, they can go to their gaps. They can look at who the top real estate agents are. They can use lists of, current homes that fall into where, the boundaries of, that might be eligible for SPCP, things like that. But that didn't always work, right? So then we heard, well, why isn't that working? Well, we would look at that and we'd say, okay, well, you may have the right realtors, but you may not have the right program. You may have the right program, but you don't have the right loan officers. And so as a result, we added, loan officer performance data so that we could help our clients track all of these different pieces. Same thing with the community partners. There were always these holes of that comprehensive strategy. So now we have, nonprofits and the locations of churches and schools, universities, hospitals. And the reason I bring that up is because when you start thinking about all those different pieces of information and you start thinking about what it means to be innovative, you can never be innovative in a vacuum, right? You can never do something that is over here and not wrapped into everything else you're doing. And that brings me to a question for Lindsay, because early on she talked when we were having our calls about the importance of designing a program that is somewhat mission-based. And I think that kind of fits together with, the notion, and, Gabe certainly could also give us more insight into all the different pieces we have to think about. But mission and, how does one single strategy and program work in a, if you really look at an institution as an organism, how does it work in that organism? I'd love to hear kind of you recap that again, because you did such a good job last time.
Yeah, absolutely. Well, for us, our credit union has been in our state the #1 mortgage lender, right? And so being #1, we want to make sure that we are serving all people. And when you in a state like Iowa, where we were number 6, having the worst homeownership gap, it was really realizing that we were a part of the problem. And then as several, Jason, Evan, Mose have mentioned, bringing all parties into the conversation. So internally, making sure that our senior leadership team was on board, our board of directors, people in our accounts resolutions department, really talking about all the different components of the program, but also bringing the community into it, making sure that we had community partners at the table that are already doing this work, already working with these populations, already having the connections and the trust in the community, and listening to their voices about how they have impacted this community and how can we weave all of what they've done into our program. And then as Mose, the biggest piece of this is making sure you have people that are working in your organization that can meet these communities where they're at. Being able to speak the same language is it's huge, and it's barriers in home ownership when people don't feel like they see themselves represented, when they can't come and sit down and speak in their native language. That is a problem. And so I believe it was Jason that mentioned, we are also seeing just by having people in the organization that represent, there are people that are coming that are applying and being approved in traditional products, and they're being approved with no assistance, with no additional help, with no different levers that are being pulled. And so I think that's a testament to people not knowing where they're at, but feeling like they can trust an organization and an institution and come in and be served the way they want to be served. And so we also, early on, we had talked about with the special purpose credit program and having it mission aligned, it doesn't necessarily have to be for minorities. Your special purpose credit program, if you're an organization that is focused on women, it can be a program that is serving women. It can be a program that is serving veterans. But the closer that it's aligned with your mission, the more success you're going to have, because everyone in your organization is on board and is working towards that mission.
Looking at the time, and I realized that, like we have gone through time quickly, and we've probably only covered, I'd say, a drop in the bucket of what we could with special purpose credit programs. But I do want to jump to one piece and ask Olivia to tee up a discussion of evaluation and what, how does evaluation fit in? You can talk a little bit about duration, maybe throw in a word or two about a written plan. How do you know and how do you think about all the things we're saying at the end of the day? Is this working? And has it been good for us? Has it been good for our market? And has it been good for our investors?
Yeah, so there's a lot of ways to think about a success of a special purpose credit program. I'm going to break it into 3 different categories, but at the outset, it's really important to understand that success and evaluation of success, it's not backward looking. Yes, Regulation B does have a requirement that a special purpose credit program has a duration, and that at that point in time, the program is reevaluated and the need for it prospectively is reconsidered, because the special purpose credit program concept was not intended to be it wasn't intended to be in existence forever. But you should be evaluating the success of your program at the beginning stages when you're developing it. You want to make sure that you're developing and setting yourself up for success, and then continually as your program is being implemented. And so, there's 3 components that I think about with respect to a successful special purpose credit program. When you do get to the implementation stage, is your program being implemented in accordance with the written plan that you have established? And is the program being implemented in the way that you said it was going to be? You have to set out what are the procedures and the standards for your program in your written plan, and you've got to monitor those just like you would with respect to any other new product or program or initiative that your bank is rolling out. It wouldn't be realistic to think that there might never be an issue with your program as you deploy it, but the measure of success here is, do you have the measures in place to identify any issues early on, to implement corrective action to prevent that issue from happening in the future? And do you have that communication and escalation plan to ensure that all appropriate folks with decision-making authority and with oversight of the special purpose credit program have awareness? So monitoring your plan for success involves considering whether it is being implemented in the way that you said it would be. Number two, very basic, are you making loans? And if not, why not? And it's especially important to monitor this, throughout the duration of your program. You might expect that when you first implement it and in the ramp up period, you might not be making a lot of loans, but you should be considering every couple months on making sure that you've got data on where the loans are being made, and also where the close calls with denials are and what are the reasons for those denials. I've had programs that have been amended along the way because feedback was coming back from the sales force or from others who were working with community members about why certain close call loans were being denied, and the bank was able to consider, is there something that we can do to adjust the special product offering or the special terms or the definition of the class receiving the product in order to better achieve our goal of helping the folks with the special credit need that we've identified. So a small example would be, if you've defined a special purpose credit program to be available with respect to certain census tracts within the boundaries of a particular city, and you know that there's a lot of denials that are happening right on the outside boundaries of that city because there's minority neighborhoods right outside the city that really do make up part of the market, but based on your definition, they're excluded from the program. An option would be to amend the program to include those geographies because they really are within the market that you identified as having a need, and then that will better serve the goals that you had implemented at the outset. So don't be afraid to make changes to your program based on data and observations that you're noting as you're going along to ensure that you are in fact making loans under your program. And then number three, and this goes back to some of the things that Jason was saying earlier, is your program allowing for sustainable home ownership? And so this one is, it might take a little bit of time to ensure that those loans are still performing, but you want to keep your finger on that trigger as well to ensure that the folks that are receiving loans under your special purpose credit program are in fact able to retain their homes and be successful homeowners. And there's some things that you can do at the outset with respect to, perhaps requiring a credit counseling, even that the bank might cover the cost of, or achieves through HUD or through a nonprofit or in some way. And keeping your finger on the trigger of ensuring that with regard to whatever your special purpose credit program looks like, that the borrowers do have the ability to repay. And so it's going to be critical measure of success to ensure that the folks that receive your special loan product are remaining in their homes. So those three components of success: are you implementing the plan the way that you said you would? Are you making loans under your plan? And are those loans sustainable loans?
Well, and I want to just take a minute here and just remind you, we're at about 15 minutes to the hour. If you have any more questions, we have quite a few in the queue already, but please type them in now. Gabe, there have been a number of questions really asking two of things I would love to hear your thoughts on. One is obviously, how do SPCPs work for all types of institutions? Are they saleable? I think that's a big question. And then right after that, could you also talk a little bit about how lenders can participate in an SPCP without building their own?
Okay, well, thank you for the setup on question two. The first question there about institution type, you do see a lot of these early successes coming out of banks that have portfolios, and credit unions may have a portfolio as well. Or it may be a CDFI credit union that has raised capital for this particular portfolio deployment. And so we see a lot of that success in the portfolio groups, but That is not to say, and the GSEs will remind you, and your account rep at your GSE will remind you, that you can work within the credit box and within the seller guide to create an SPCP. So any IMB who sells 100% of their production can absolutely make an SPCP. Does that mean that you will likely have some sort of enhancement on that program, or you are giving up some sort of income in some way to make that program better for the target population? Yes, it probably does. Will you be achieving other goals while you do this? Yes, and you have to weigh out those costs. There are also, and we have seen secondary market buyers who want to buy GSE eligible loans and will pay a premium if those loans meet various criteria. And so I say that to say that if you can strike a deal on the secondary market side where you're still making a GSE conforming loan, but you have a specialty seller or buyer that you can sell that to, then you might achieve a premium on that sale that would pay for your concessions or your credits on the front end to the consumer. And not often enough have we seen the people who drive the characteristics of the loans be directly benefited by the secondary market pay-ups that happen from those loans. And so the more we can see that happening, the better. And certainly it's where an IMB can look at a revenue source that would counter the expense on the production side. So thanks for that. Good reference there. The second thing is, how do you do this if you don't have an SPCP? So yourself. So if you don't have an SPCP first mortgage product for purchase, there are SPCP down payment assistance programs that you could participate in. And those are hosted by nonprofits like ourselves, right? So we built Equity DPA to be a national facilitation and assistance of this solution here, where essentially we as the nonprofit are providing the SPCP guidelines, and lender partners are helping consumers access that, but the lender themselves doesn't have the SPCP. So if it's too much of a hurdle to make your own, then participate with a nonprofit. And many times nonprofits, including some credit unions, have down payment assistance programs that are targeted to communities. And if you are the first mortgage lender that's working with that down payment assistance program, by effect, your transaction will have been benefited by SPCP, even if you didn't have an SPCP product yourself. And that also speaks to Jason's reference of sometimes you don't need to make an SPCP. Sometimes you need to deploy tools, products, programs, sales strategies, and tactics that would better achieve reaching these communities and that don't require, per se, your own SPCP product.
The other thing I would just add there, because there was a related question about doing SPCPs through like a TPO channel, I think I saw in the Q&A. I'd say if you're an IMB or you don't have a port, it may be worth checking in with some of your bank friends who are in the SPCP world or who are in the portfolio lending space. If you have a third-party relationship, you might find that some are more open to exploring the idea of doing community or port products through this channel as part of their distribution strategies. So that's an avenue as well to potentially gain access. I don't want to opine on whether that means you need to develop your own SPCP. But certainly, if your bank friend or their lender is offering that, they will have one.
I'm gonna kind of go back, and I'd love to hear from each of actually each one of you. We've got about 10 minutes left, and again, such a deep topic. I think we could have done, 2 days worth of workshops and still just, scratch the top of it. I'll start with Evan. Evan, as we wrap this up, you're not just somebody in this space. You're someone who I know is extremely committed, like Jason, very knowledgeable on different things. Dipping your feet into SPCP, what, sort of parting thoughts or words of wisdom do you want to share with everyone who's listening, or or if there's a question that somebody didn't ask that you think we should be answering, what is that?
Yeah, thanks, Laird. I think I kind of want to tie something that's been a hot topic in the Q&A session into the bigger picture here. And it's been a lot around MLO compensation. And if you've been around the mortgage banking business, there's a million different ways to structure comp plans and incentive plans and overrides and this and that and the other thing. One thing that remains true is you would not have an SPCP if you were meeting the credit needs of that community, whether it's geographically focused like a neighborhood or a census tract, or it's demographically focused like on a particular gender or ethnicity or race. An SPCP lends voice to, I'm not doing a good enough job today, or I see room for improvement. And so don't think of this as you're going to serve this population with some other product offering that you already have, right? Otherwise, you already would be doing it and therefore would not have a need for an SPCP. The SPCP allows you to think creatively, but responsibly, particularly for those of you who are publicly traded financial institutions, about striking the balance of returning that value to your shareholders while also doing the right thing for the community. And so if you adopt that philosophy of doing right by both entities, then you're going to have to think about compensation differently. You're going to have to think about marketing differently. You're going to have to think about credit, DTI, LTV, DPA, CCA, all these things differently than you do today. And when I got really honest with myself and the executive leadership team at my bank that ultimately approved the SPCP, we all agreed we have to do better and are putting mechanisms in place to make sure that our MLOs aren't the ones who feel the brunt of that expense or that challenge due to a smaller loan amount, to make sure that we're working with more diverse vendors who represent those communities that we're trying to reach. So I challenge you to get outside of your traditional comfort zone. All of the folks on this panel are super open books. We are totally happy to chat with you offline about our thoughts and processes, and frankly, be a safe space for that creative thinking that you might not ready to be doing in front of your executive leadership team or board of directors. So I would encourage you, use today as a launch pad to reach out, learn more, and find more opportunities to just do the right thing for your organization and for the communities you serve, because neither one of you will be sad if you go down that path.
Always so well said, Evan. And I can say that the two themes keep resonating that make me excited. And one is this idea, Jason said it, I said it on the first slide, you mentioned it, the idea that we can find a win-win, right? And a win-win responsibly. And I can't help but think about, data and the role that, whether it's quantitative, qualitative information sharing like this, how important it is to get information from all the different pieces. And before I ask Rob what he wants to add, I do want to say one thing that I want to make sure that, that we talk about, and that's the importance of thinking about the logic model of the problem, right? If we go back to thinking, all right, every innovation or intervention that we do should fit into should work on one piece of those gaps of the causes we see behind the problem we're trying to solve. And with that, I think one of the things we talk about is the education gap. And I just want to share, because with Convergence Columbus, we did a loan officer survey and kind of got some unexpected results, and also a real estate professional survey. And what we realized is that oftentimes we're focused on borrower education. And clearly when you look at the rates and you see the withdrawal and the incompletions and the fact that there's so many probably mortgage ready borrowers who aren't connecting, with a lender. But the other piece of that I want to bring up is the importance of education between practitioners. Right. And one of the reasons that I say that is because it ends up being a win-win in another way. I mean, what we saw through the survey was that, what loan officers knew to be true about their institution's products and what realtors knew to be true about an institution's products were not closely aligned at all. And so when you're thinking about strategies for, let's say when you're thinking about strategies for working and building your realtor base, think about that logic model. Think about solving a problem while you're, doing the kinds of sales and outreach techniques that have been done for a while. Think about adding that value and increasing education and being a trusted advisor, whether it's with realtors or, like Jason mentioned, others in the community, but always trying to think about the connections that you're making, being relevant, again, to the future we want to see. So that's what I have to say. Rob, your turn. I know you have something to think, you have some thoughts too, as a practitioner in the field.
Yeah, thanks, Laird. So I guess my big observation, something I've been really focused on in the last year or so, is the world is changing. This world is changing. Consumers generally, and still most consumers are not aware there's such a thing called down payment assistance. So they're not looking for it. They're not asking for help. But think about this. Today, when everybody starts their home search online, and today, when you're searching online on certain real estate sites, you can find down payment assistance to go with the home you're looking at. I mean, the specific home you're looking at. If that home's eligible for programs, some of our partners are displaying the programs that are available for that home, and then giving the consumer the opportunity to answer 6 or 7 questions and see which of those programs they would be eligible for. And this is happening at a scale, by an order of magnitude than we've seen in our history. So the genie's out of the bottle. More consumers are learning about it, and they're going to be holding their real estate professionals accountable. They're going to be coming to lenders and real estate agents saying, hey, I found out I'm eligible for these programs. Can you help me with it? And, hopefully the answer is yes, but, if not, they're going to go somewhere else. But, both Jason and originally Gabe mentioned the blue ocean concept. This is a blue ocean still. This is still newsworthy to consumers. So it's a huge opportunity for lenders and for real estate agents to develop the skill set. You don't have to be necessarily a subject matter expert, but develop your competency. As Mosey had, she's a walking, talking poster child, as well as Lindsay and her organization, and Jason and Evan. You guys are out there getting the word out. You're able to help these people, and it's still news to them. It's a big blue ocean, and it's worth the effort. That's my 2 cents.
Well, we have 2 minutes. So, all right, we're going to go quickly here. I still need to hear some words of wisdom from each person. Let's go, Mosey.
I'll piggyback on Rob. I'm super blessed to even be on this panel with everyone, because everybody bought their A game, had such great points. But dive in head first. Be an expert at the subject matter. Know your community so you can deliver. I really think there's opportunity to deliver loans with or without down payment assistance or special programs. If everybody really gets in there and analyzes each application to help each buyer where they're at, period. So it'll help the organization and time really well.
I'm going kitty corner. Jason.
Lots of LO questions in the Q&A. That should point to maybe something to consider when you want to increase your distribution, and also please comply with Reg Z's rules on LO comp. I feel like I should say that. And then 2, don't be intimidated by the work with an SPCP. There's a lot of resources out there that can really make this easy. At the end of the day, it's analyzing data and writing up justification based on data, which is pretty much what all of us do from a business case perspective today for our lives. So it can be intimidating, but it's not that hard.
And with that intimidating thing, I'm going to have Lindsay talk, Olivia, and then Gabe can wrap it up. So Lindsay.
Just pointing back to one thing Olivia said earlier, don't be afraid to evolve your program. It's not limited to first home buyers. Think of home ownership as not only decreasing the gap in ownership, but also increasing the sustainability. So think about your home equity products and the ways that you can evolve any product that you're currently offering to fit the need in your community.
Your turn,
Yeah.
Olivia.
Piggybacking off of that, there's also a lot of creative options for the features that your special product might have. We've talked a lot about purchase products. There's also home improvement needs to ensure sustainable home ownership
Yes.
in a lot of communities. So really, this all ties back to what is the need in the community in which you operate. And thanks so much for joining us.
Okay, Gabe.
I would just say it's up to the lenders of America to, we've got to close this gap. We all have to stay focused on it. We should be thinking about increasing minority home ownership at a faster pace than any other, wherever possible, because that's going to narrow the gap. And you can do it. It is happening. We're starting to see some narrowing, so keep at it. And well done to those who've already come to market or who are already done their planning and are about to come to market with SPCPs.
Well, I'm going to wrap this up, thanking all of you presenters. You've been fantastic. It's always a pleasure. I'm going to thank all of the people who just spent 2 hours with us listening. And I want to let you know that we will be sending access to the recording and slides and some other resources in the next few days. We unfortunately didn't get through all the slides, so we may need a couple of days to put them together for you, but do be on the lookout for that. And again, thank you all, and reach out. In the slides, you'll have contact info from everyone on here. You guys have been great. And again, thanks to these experts for bringing this really important win-win opportunity to the table, front and center, because the time is now. How's that? Bye, guys.
Bye.
Bye.